Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the market has certainly recovered since the mid-June lows, and we're getting a little pullback here. And one of the questions we often get, or at least most recently have received, is, Chris and team, has the markets bottomed yet? Or maybe this is a bear market rally. Now, you may recall this bear market has been challenging, and obviously, depending on what industry you're looking at, has from the top to the June lows has come down around 20 to 30%. Now, again, we've had a over 20%, depending on the industry's recovery. Is this a bear market rally or not? Now, again, a bear market rally is basically a short-term rally in a larger term downtrend. Bank of America has an indicator that has a very good track record. So I thought I'd share it with you today and talk a little bit about what they think. Now, there's a lot of indicators that many money managers and institutions use, and some have historically been quite accurate. And of course, there's no perfect indicator, so I want you to keep that in mind as we go through this. But this, again, has a very good track record, so I thought I would share it with you. So Bank of America, again, they have this very credible indicator, and their feeling is, based on what the indicator is saying, is that stocks likely have more room to fall, which means that we may get, or very likely get, per them, back to the June lows or maybe even further. Only 30% of the firm's bull market indicators have been triggered in this current time frame versus over 80% in previous bear market bottoms. And this one signal, again, has a great track record, has yet to signal a market bottom. So what's that indicator? It's called the Rule of 20 per Bank of America. So the Rule of 20, which effectively is the sum of a year-over-year CPI, so CPI growth, which again, as you know, is inflation, and trailing PE. You may recall PE is the price to earnings ratio, which effectively means the dollar amount per dollar of earnings that someone is willing to pay for a stock. So if a PE is a 20, which it is at now, you're basically willing to pay $20 per dollar of a company's earnings. So again, right now, that ratio says the indicator's at 28.5. Again, CPI growth plus trailing PE right now is at 28.5. PE is 20. As you know, the latest CPI number is 8.5%, so 28.5. Well, again, historically speaking, based on this indicator that's been around for many, many decades, you can see where we are on the far right. So 28.5, which is above the mean, which in their mind is 20, we still have more room to drop. You could see, again, looking at the far right, you may recall back in the last quarter of 2018, where the market from October to December was actually down 20%, that this ratio fell below this line. And as you note, if you look at the financial crisis, 07, 08, 09, where the market peaked in 07 and bottomed in March of 2009, this ratio was way below this, this mean of 20. Looking back at, in the dot-com years prior, mid to late 90s, you can see how far this ratio was above the mean of 20. So whether this indicator is right or wrong, we shall see. But looking at his history, again, this Bank of America indicator has a very good track record. And it's my position, or our position, that there's no one great, perfect indicator that you could rely on. What you look at in an ideal situation is the totality of the evidence to give you an idea of where we are in the market cycle, whether the market is potentially bottomed or not. And then you take the totality of the evidence, because what you're doing effectively is looking for just an edge or an advantage, or to have probability in your favor. And then you make an intelligent decision. So is there a very real chance that we're simply in a bear market rally? This indicator effectively saying yes. There's a number of metrics that we, again, look at to determine if we're in a bear market rally or if the worst is behind us. And going back to some additional data to that end, there are other metrics that are part of this calculation, and they're typically show up in bear market bottoms, and they include Fed rate cuts. Now, as you know, the Fed's increasing rates, and they've been slated to do that 2 or 3 times over the next, let's call it at least till the end of the year and maybe early next year, where they want to get the Fed funds rate at around 325 in that, in that range. Of course, rising unemployment. Now we are starting to see some layoffs, so that could be the sign, that we're starting to near a market bottom and a steepening yield curve. So again, take the totality of the evidence, put together, the data, if you will, and make an intelligent decision to put odds in your favor, and ideally it works out. There's a very real chance, as I noted earlier, this is simply a bear market rally, and we have more room to fall. Whether again the June lows get taken out we'll have to wait and see. All that to say is, if you would like a second opinion on your portfolio or financial situation, you can go on our website, click on the upper right-hand tab on the Contact Us tab, fill out the information, and one of our advisors will get to you and answer your questions to the best of our ability. Hopefully give you some clarity so we can help you with your financial life. Thanks again for watching. Bye-bye.